Here we go, here we go, here we go, here we go. It is the Fed live stream. Let's go. Hey, what's going on, everybody? This is the Blockchain Backer, bringing you the latest cryptocurrency news and analysis. Welcome to the Fed live stream. Today is September 17th, 2025, and we are 4 minutes away from getting the first interest rate cut of 2025. Market on extreme edge as we head into this moment. Certainly a intense moment for sure, and we've all been kind of waiting on it. And woo! All right, here we go. Right. So if you're tuning into this, you're watching the replay of it. Skip ahead 4 minutes from right now. You'll see how the market reacts to the rate decision, and then skip ahead 34 minutes, and you'll see Jerome Powell come on stage. So typically when we go through events like this, I'll just kind of give you a recap of how they typically go. We tend to see a lot of volatility show up throughout the markets. Many times the first move that we see is not the real move. We'll see lots of intra-meeting moves that happen in here. It can be totally, absolutely, and utterly chaotic. And no telling what. We've seen it many times where the market will dump into the press release and then rip into Jerome Powell coming on stage. We've also seen the polar opposite. We've also seen things stay relatively flat. But of course, going into today, it's a highly anticipated cut. And the question is whether or not the Fed is going to communicate that this is like officially the Fed put. This is the beginning of moving towards accommodative stance for monetary conditions and how the Fed's going to behave. So everybody's on edge on that, right? So the market is totally priced in the 25 basis point rate cut. That's not going to be a surprise in any way. The thing we're all waiting for truly is Jerome Powell and what he's going to communicate and what that's going to end up looking like, and if we're going to see a pivot happen in here. And if we can finally move on to a risk-on market that will show some type of expansion. As we know, this market has been very consolidated into the Russell 2000 and not the Russell 2000, the S&P 500, NASDAQ, and Dow Jones, all the major caps, right? And we've seen the Russell 2000 stall out along with the altcoin market and everything like that. So we're looking for this thing to be able to go and for the conditions to present themselves. We know we have total 2 back at the all-time high. It's like 3% away from the all-time high. You got the Russell 2000 just about 1.5% from the all-time high. So, all right, I'm going to quit rambling for a minute. Chieftain Blackbeard came out swinging with 50 before the stream even started. 50 memberships. Brother, thank you again. Dude, you're just unbelievable. But it's time to get down to business and get ready for this thing to present itself here. So here's what we've got right now. We've got the July 30th press release that I've got here on the screen. In just about 1 minute from right now, we're going to get the rate decision, and then we'll see how markets react to that. So I've got this thing all going right here. We'll F5 this until this, refresh this until it ends up showing up, and then we'll kind of compare the two. We'll see what the decision is, and then we'll be able to bounce back and forth in here. And then, of course, on the bottom left of the screen, we'll talk more about that. That's going to be the Fed live stream in here just in a minute. So it looks like crypto is flipping a little bit more green heading into the meeting preparations. Yeah, I don't know. It's hard to know that. Why are we going green, right? Why are we flipping a little bit green here right before this thing? We shall find an auto. All right, we are 20 seconds away from the decision. We are at 4,800 people in this stream. You can tell this is an anticipated Fed cut. Again, I have no idea how the market's going to react to this. We're going to literally find out together. So here we go in approximately 5 seconds from right now. So we'll go ahead and start refreshing this. Still refreshing. Still refreshing. Still refreshing. There it is. A quarter point. All right, so they cut a quarter point. Let's see the initial reaction by the market. Dollar down. A huge move in RTY. Hold up. 24.34 in RTY. It had a little bit of a pop. We'll go to the 1 minute time frame. Why not, right? There you go. There's the Russell 2000. Again, first move, not always the move, right? So we have to still be cautious on this. Doesn't mean anything. We still have to get Powell to come on TV. So it looks like a little bit of recovery here and any type of weird reaction that we had there for Bitcoin. Look at that weird reaction that happened right there. Was that true over there on Coinbase too? Yeah, that was true there on Coinbase as well. So volatility for sure. Again, we can't trust any of this until Powell comes on stage. So let me reset these things back to the way they were. Where'd it go? There it is. Okay. Sorry. Okay. We'll clean that up a little bit later. As for gold, gold went up a little bit, now shot down. Okay, dollar down. Indexes relatively unchanged. Relatively unchanged. Okay, let's go ahead and read this thing, right? Recent indicators suggest that growth in economic activity moderated in the first half of the year. Job gains have slowed, and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks of both sides of its dual mandate and judges that downside risks to employment have risen. In support of its goal and in light of the shift in the balance of risks, the committee decided to lower the target range for the federal funds rate by 1/4 of a percentage point, or 0.25%, to 4 to 4.25%. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2%. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So not a whole lot of information in here, nothing new that we didn't already know. That unemployment risks and things like that were rising. We knew that. That's a lot of why the market really priced in that there would end up being that 1/4 percentage point. They didn't really give any forward guidance and anything in here like that. You know, I think the one thing you could have looked for in here to be like, ooh, that's awesome, would be if they said like, they'll reduce the rate or stop, QT and stuff like that. So that remained unchanged. QT still remains. The only thing that you really got out of here is that 1/4 point reduction. So the market's going to be looking to Jerome Powell to give some type of information on that. But we see the Russell moving. Oh boy. Okay. The Russell is currently 0.6% away from the 2021 all-time high. This other line that I have right here, that is the peak that was set right over here, where we slipped above that 2021 all-time high back in November, but we're unable to sustain it. This is the 2021 high, and then this is going to be that November high. But we are ripping. The Russell is ripping. Again, can't trust it until Powell comes out. We can't do anything about it until Powell comes out. I think one of the concerns I had would be like, what happens if we get all the way up here and then Powell comes on? We don't know right now. So don't try to overread into this until we get Powell. And if he gives some type of lingo that gives something to say, hey, it's time to rip. But what's official? We have cut. Now the question is that people are going to want answered from Powell's presser is that he doesn't use lingo to say this is just a mid-cycle adjustment, but that he says something more along the lines of, dang, look at that, 0.32%. We're only 6 points away from the 2021 all-time high for the Russell. Okay, that he says something more along the lines that we are moving towards a. I can't even think right now. Anyway, non-restrictive policy, right? So that's what we're looking at. I think we can just zoom in on this. Why even play around, right? All right, there you go. All right, you're 5 points away from the 2021 all-time high for the Russell. Total 2, how are you doing? Crypto market, slightly green. All eyes, of course, over here on the Russell. Oh boy. Oh boy. 3 points away from the all-time high, 2021. Okay. Again, it means nothing. Powell's got to come out here and do some magic. Oh boy. .2 away. Oh, Senor Powell. Don't come rain on this parade. All right. So what differences are there? Here, I better do this. So we'll just ding it in that way if I'm not paying attention. That way we can all hear it. 9 points away. That way if it crosses and I'm not paying attention, we'll be able to figure that out. So plug your ears, because if that thing dings, it's loud as can be. But just know that ding's a good sound. Are you nervous, BCB? Well, I mean, yeah, it's a critical moment. I think I've tried to set that whole stage for everybody of how big of a moment it is right now. This is the thing. Are you going to reject off the all-time high, or are you going to bust out and go into an expansion? Right? You got that over here with Russell, and you got that over there with the total 2. I think it's like a no-brainer. This is a massive moment in markets, right? So I don't know. We'll see what Powell does. The Dow is up 443 points. All right, are we going to read this thing? Here's what I might do. Let me try this. Go over here. The wonders of ChatGPT. Tell me the differences between these two. And then this one. This way I don't have to read everything to you and just guess and do that whole back and forth stuff. What's it say? First statement, no cut. It mentions swings in net exports, says growth moderated, but stresses unemployment, inflation somewhat elevated, overall tone. Wait, did we get inflation is somewhat elevated in this one? Yeah, we did. Yeah. The second statement does not talk about, so today does not talk about net exports compared to the last one. It adds that job gains have slowed and unemployment has edged up. Inflation has moved up and remains elevated. Adds explicit lines that judges that downside risks to employment have risen. The overall tone for the second one is that the labor market is softening and risks more balanced towards weakness. So they've come out, which is not surprising for them to come out and say that there's more weakness. That actually is not a surprise at all. It means it's kind of good that they're just addressing it. But that sets the stage for what comes next on if Powell is going to come out and say that we're ready to fire bazookas. I think that's what everybody wants to hear, that yes, there are downside risks, but we are ready. And it's not a whole, like we get in every single one of these things. So, okay, there's a lot going on, right? So we are just mere ticks away from touching the all-time high for the Russell 2000, but we can many times know the first move is not the real move. We have to get Powell to push it out, right? And crypto, gold is up now. Gold's all over the place too. Stocks, not a whole lot changing, but as you could see, like Russell is the best behavior today, which of course is what we're looking for in this whole thing, right? The Russell is up 1.8% versus the Dow, which is 0.95%. The S&P is 0.05%, and the NASDAQ is negative 0.33%. We're looking for an environment where the Russell becomes the winner. Hey, we just got a new low in the dollar. Total 2 still sitting up there. Russell still sitting up there. It's still waiting for Powell to come out. 2-month yield. Yep. So again, the yields told us we got a 0.25% rate cut. And no real strong forward guidance in there, but it does acknowledges that, unemployment is starting to tick up a little bit. And that's exactly what we expected for them to say. Now it's just that, okay, now that they're acknowledging that there's some weakness emerging in there, are they ready to come out and say, we're ready to fire the bazookas? The market is pretty much looking for them to not say this is a mid-cycle policy adjustment for them to come out and say, we're going to start moving towards an accommodative stance. So you can expect more of these to come. This is not the only one. So, all right, there you go. Not quite ready on the Russell. We're going to have to wait for Powell to come out. It got up within like a point. It got within 1 point of the 2021 all-time high on the rate cut, but not quite. So just a tease. Okay, I'll put it right there. It's just too hard to see it when we're that zoomed out, right? I bet you guys want it zoomed in. Okay, there you go. Crypto all over the place. No strong move for crypto because we don't see total 2 escaping. Okay. All right, there we go. I think that's the chaos of everything happening from at least the rate decision. So I'll put this here on the screen. Fed cut 0.25%. And we'll for all the people who tune in late, is there a little check mark I can put? There you go. For the people who tune in late, they're like, hey, what happened? There you go. And then now we wait to see. Oh, look at that. Waiting for Powell. All right, so we'll hop into the chat. We essentially now are going to burn about 17 minutes. And so let me explain what happens in here. First of all, this is actually our last Fed meeting. So I figured this would be the big one. I don't want to do Fed meetings for forever. So this, I've been announcing it for like 2 months. This will be our last one. It's appropriate. We have 7,000 people in here to watch this thing and to see how the market's going to react to Powell coming out here. But the way it works is in 17 minutes, Powell will come on stage. I will shut my yapper after finding a way to burn time for the next 17 minutes. And then I will make this a little bit larger. And we're going to watch the press conference with Jerome Powell. He will talk. I will be quiet. I will provide no commentary on whatever Powell does and whatever the markets end up doing during that time. Okay. Then, once it's all over, we just kind of wrap it up. There's not a whole lot of commentary on it because you know what? Today's probably going to be volatile. Tomorrow's going to be volatile. The next day is going to be volatile. It's going to be probably pretty chaotic, and we'll just have to wait and see. I mean, I have the frog loaded. The frog's ready, but the frog only gets loaded on a breakout out of the actual all-time high and some type of expansion. And frankly, I think if we're going to see it, we need to see Total 2 do it at the exact same time. But we can already see massive volatility. All right, we essentially went up and touched the all-time high for the Russell on this news, and boom, we've taken it all back already. It's going to be chaotic today. This is just the beginning. And then once the stream is all over, if we get the break, if everything goes, then we play the frog, and I just wrap it up and close out the stream. If we don't get the break, then I don't play the frog, and we still wrap it up, and that's the end of the stream. And then we let the markets play themselves out throughout the afternoon and then into tomorrow morning. And of course, I put out a video tomorrow and kind of recap everything that happened and how the markets reacted to it and all that kind of stuff. As of right now, I'm just like the rest of you. I don't know how this market's going to react to it. It's already been crazy. You've already seen it go stab at the all-time high. The first move, yikes. First move, took a stab at it, and now it's taking it all back. Now Powell's really got to come in and save the day at this point. But we'll wait and see. So I'm blind just like you, so there's no point in me providing analysis in the heat of this type of moment at the same time, unless we get a break. Then we can all celebrate. But Powell's going to have to come in here and do some type of crazy miracle. All right, so now what we'll do is hop into the chat. You guys essentially have about 15 minutes to go get your beverages, to get your snacks, to get everything to get settled in for an hour of hard swallows and throat clears as Powell then comes out to take the stage and try to calm markets down and assure the market that things are going to be okay. So, all right. Hans Loaded, member for 28 months, said smash the like button. Yes, thank you. We already have 1,200 likes. We have 7,000 people in here waiting. John, member for 18 months. Thanks for being my guiding light in the markets for all these years. Also, everybody smash that like button. Let's go. Yes, thank you. All you have to do is close the chat, hit the like, click on live chat again, and that's it. XP Market, member for 29 months, brother. What's up? What needs to happen to get frogs today? To get frogs, I probably want to see both these things happen. Probably see Russell go and Total 2 go. It can't just be probably one or the other. Probably has to be both. And that would be a pretty aggressive move to have to happen in one stream. Otherwise, I don't want to incite a false start, right? We've seen a lot of chaos action. I think we saw XRP hit like 307 before the rate decision. Then it went down to 302. Then it went to 307 again. And then now back to 301 as we're waiting for Powell to come out. So I think we have to see Total 2 actually legitimately escape. We need to see pure madness. I don't want to false celebrate. I want to see Russell and I want to see Total 2 escape in order to celebrate. And so that's a tall order, right? I'm asking a lot of the market there. So we're highly volatile. Oscar Hernandez said, hit the like button. Brother, thank you. And I noticed it when I got back to my computer after the stream was over that you had gifted 5 memberships at the very end, like you always do. You always mess with me, bro. Thank you. Oscar, you're number 1 today. And then Eric Martinson, listen to Oscar and hit that like button. What's up, guys? Dorian, 33333 Gray. CNBC says Fed says they see 2 more cuts coming this year. Well, the Fed hasn't made that announcement yet, but they will, hopefully, soon. I mean, that's what Powell needs to come out and do. Powell has to come out and say there's going to be more of these. Jonas Fugalis. 6,000 viewers. Yeah, well, this is the rate cut, right? The market. How many of these have we done this year? This is probably the 7th this year. And so all of them have just been pauses. Pause, 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 pause. These typically do much better than markets in the morning. Even though they're pauses, we still end up having 4,500 to 5,000 people in the Fed live streams. But this obviously is a bigger one. This is one where we're looking to see if we're getting the Fed put. Because the Fed flinched, right? They finally flinched. Something caused them to flinch. So now everybody wants to know. Hey, is that a trajectory change or is this a one-off event? Oscar again says, let's hit the like button. Pew Pew, member for 12 months. Does this mean no sleep season starts today? No. I mean, it could. It could if the Russell 2000 broke out and if Total 2 broke out at the same time. Yeah, that would mean we are in no sleep season. Florin, member for 15 months, said, hey, BCB, in the market since summer of 2018, all the ups and downs. I should be immune to everything crypto, but this time it feels off for some reason. Yeah, the whole market feels that way. For being at all-time highs, we talk about this a lot. I'll repeat it just because we have a lot of people in here right now, maybe people who don't typically tune into other things like markets in the morning or watch all the videos. Sentiment is, at very neutral right now. And that's very odd that sentiment would be neutral at these levels. Essentially the crowd very fearful, very concerned, very worried. You have the mix of gold rocketing, right? You have these rate decisions. You have all-time high jitters. You can see it in a lot of the data. I can see it in a lot of my own data on here, how the crowd certainly feels like bear market vibes, right? And like all my data looks like that. It's like I have very clear data that shows how my social media engagements, my viewership things, everything that I have as doing this for years. I've been doing YouTube for 6 years. How it always fluctuates with these things, and I can always see it, right? And so what you would think is that in engagements and everything in here, you would essentially see the same repeating things happening in here, and you'd see social media things, and you'd see like Coinbase app downloads, things like that, showing that trend up in here. But while we're up here, the crowd sentiment is the same as in here. It's very bizarre, right? And so you get that a lot of times back at the all-time high with the all-time high jitters. But the market's all anticipating, right? Because we've all seen this. Like, I think especially for people who are here in 2021, because we don't really have a class of 2025 yet. In order to get a class of 2025, you have to have breakouts, right? The normies have to come piling into the market, and they come in or, we're all diamond handers, right? We're all laserizing diamond handers, even though we're buying once we're in the new all-time highs. That's typically what the new crowd does. At least all of you who entered in 2021 did. Turns out a lot of them were not laserized diamond handers, were they? They were just top buyers. But what we got to witness in 2021 was how many assets went back to the all-time high, right? Only 20% of assets were capable of touching their all-time highs and going into their all-time highs. 80% of assets were not, and we're just talking about the top 100 in the crypto market. And of those 20% that touched or went into their all-time highs, we're not even talking about went into all-time highs. A lot of them just touched, like Stellar Lemons or Litecoin or Monero. They count in that 20%, but they only hit the all-time high. They weren't able to get out, right? So there's a lot of PTSD, of course, of being back at these levels. But what we do typically end up seeing when we get back to these levels is the crowd at least being euphoric in some way. And by no metrics are they. None. And that's what's so fascinating about this. There's none. It's real weird. You would think the crowd would come pouring in and buy the top, but they're not. That's weird. I've never seen a top happen where they didn't. So they did here and here. And Coinbase app downloads, right? Here, always, right? Even this guy right here. Everybody, we're going to buy Bitcoin in celebration of El Salvador. Right? Like, there's something always, right? But, all right. So here we go. All right, Russell now popping back up again. We are 7 minutes away. The way you're feeling it is common, I think, for where we are right now. I think everybody knows, like, this is a very big level. Very, very big level. When you say, I should be immune to everything, but this time feels off for some reason. Well, it's because we haven't expanded. You can feel, we haven't expanded. We haven't expanded. And that's it's the biggest resistance in the world. So everybody's feeling that nervousness of being back at it. Can we get out? If we're able to get out, it's going to be kumbaya and hand holding. And if it's not, then we all go to the basement together, right? And Ahmad says, the fact that everyone is scared is giving me hope. Thank you, Ahmad. I have some catching up to do because I have 6 minutes. Paul Adrian, hit the like, lads. Hey, BCB from Romania. Hey, Paul, thanks, man. Calvin Moon, member for 8 months. Smash that like button. Thank you, guys. We are at 2,000 likes. I appreciate it, guys. Jonas Fugalis, maybe Super Chat lets me take number 2 again. It did not, sir. Mark OFGTG, member for 27 months. While there's all this excitement and optimism, I want to take a minute to check you and your family are doing okay. You've had a lot going on recently. Thank you very much. Yeah, the summer's been nuts. It's been absolutely nuts. Would not recommend. XR Priest, 4.23. I get it. 4.236. Fire the bazookas. Bassem El Kadri, member for 10 months. Thank you. Being member for less than a year, watching your channel for almost a year, and getting addicted to your content. Thank you, big time. Thank you. Joseph Sheplin, new member, welcome. Altcoin Artisan says, lots more talk lately of Congress being banned from owning stocks. Just saying, man, we just hear it all the time, right? Until something actually happens, it's just talk. Florida man, thank you very much. Hey, he's number one. Now, hey, BCB, could you live stream October 21 Federal Reserve Payment Innovation Conference in DC? Probably not. Probably not. We're talking about getting away from doing these live streams. We're not going to go digging deeper into other Fed events. We're probably done with Fed stuff. Yeah. Cameron Vaughn, is there any way to track the combined app downloads, Coinbase, Kraken, etc.? Does it not really matter? Even Robinhood has its own wall. You're just going to see it at least with Coinbase, right? You're going to at least see a trend. Like, even if it stinks, right? You're going to see it like get to like number 75 or number 50 or something. Not in bear territory of 300, 250. Make no mistake, my name is Jeff. Dogs are better than cats. Yeah, I think a lot of people will agree with that. Richard Quinn, what do you think silver will do? I don't know. We're gonna have to move quick because I have 3 minutes to get ready for this thing to go live. Garlic Band, thanks for all you. Garlic Brad. Thank you for all you do in this space, BCB. I first got in October of 2017. Since then, I've gotten married and had 2 kids. I'm ready to sell and take care of them. I feel that, brother. James Eld, frog for the one time before Jerome. I can't. Bro, stop clicking. You're making me nervous. Yeah, it was high speed, man. A lot going on. What are the main stocks that will drive Russell 2000? It's everything. It's not just main. So like that's what you're used to when it comes to the S&P 500. You're looking for a couple of stocks to hold the whole thing together. That's not what you're looking for. You're looking for everything to rip. That's the whole concept here. Breadth opens wide open and everything rips. Not just main stocks. Like that's the whole concept of what we're talking about here. We don't care about a couple of stocks. We care about the whole thing going bazooka. Everything. Bush Camp Dad. Hey, BCB, it's me, BCD. What's up, dude? Thanks for tuning in. Like Fortnite legend. Man, Robert Barker, member for 28 months. Hey, BCB, make the call. You have to pick one as a gamble. Red or black? Do we break out? Yes or no? I can't, man. I can't. I have spent a month thinking about it. Every minute. I mean, I'm talking with my wife this morning. I'm just like, I literally don't know what's going to happen during this thing. Exceed, thank you very much. Says thank you. I appreciate everything I learned from you, bro. You are the man. Thank you, very kind. Per Jerome Powell, dollar liquidity overrated. True stability is 3 letters. XRP. Thank you, Eric. Carmadillo, member for 19 months. Good luck, folks. Thanks for streaming. BCB. Thank you very much. Stickum Rob. Thank you, sir. Let's go. All right, guys. I got to get to business here. I'm about to shut my yap. Give me just a second. I'm going to be silent for just a second while I'm trying to make sure I've got everything lined up here and I've got volume going and everything like that. So hold on for 1 second. Got to turn the desktop audio off. Turn the Fed off. Let me play it. Yeah, I knew not to do that. Okay, there's the Fed. Okay, no, yeah, see, I knew it. All right, 1 second. Now we get to see if it's centered. It is. Now I can give you audio back. All right. Dude, look at that timing. All right, everybody, I wish you all the best of luck. May I see you on the other side and pray that there's new all-time highs when we do. I'm going to go ahead and go silent.
I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to a place. That's not at all.
Sorry, guys, it's not me. It's the Fed live stream. Let me refresh them.
Cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to a place. That's not at all fate. And I think
it's their website, guys. I'm working on it.
In place. I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change. In place. I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just
towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just
I don't know what's going on with their website.
Towards more cuts than just
you can see it just keeps repeating
3 months
itself.
ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just
Brutal.
Towards more cuts than
It just keeps repeating.
3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth next actually ticked up just
Dude, are they broken?
Towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this
We've been doing
in
these
a way
live
as a
streams for a
risk
long
management
time.
cut, because if you look at
has
the
never
SEP,
happened.
actually, the projections for growth next actually ticked up just
When they
actually, the projections for growth next actually ticked up just
when they
So let me just tell you guys what's going on here. So I'm reloading their feed over and over again. There's something broken on their end, not mine.
actually, the projections for growth next actually ticked up just
when they when they
This is crazy. Yeah, I don't know what to tell you guys except that I'm going to keep reloading their feed. But you can tell their feed is all jacked. It's essentially broken on their end. Brutal. Let me try. All right, let me try something. Hold on. Here's what we're gonna do. I'm gonna try. All right, we're gonna try something. Hold on one second. No, the Fed live stream is broken. Straight up. Fed YouTube is working. Fed YouTube is working. Yeah, I mean, if you want to tune into their YouTube, you can go to the YouTube. Hey.
We have to,
I'm
our
a
job is
hustler.
literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago.
Brutal.
The pass-through of the tariffs into inflation has been slower and smaller. The labor market has.
For those just tuning in and thinking, what is going on here? This is a direct feed from the Federal Reserve and their website. So whatever's going on here, we're just dealing with it.
Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent
This is crazy. Sorry, guys. It's out of my control.
The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent softened. So the case for there being a persistent labor control.
John, I can't use CNBC's feed because then I'm taken from their stuff. I can only take it directly from the Fed.
Low labor control. Low
Man, brutal.
labor control. Low
Yeah, you know, my feelings won't be hurt if you just want to go directly to the Federal Reserve's YouTube page, guys. If they've got it streaming there, people in the chat are saying that it is working there. If you want to go straight there, that may be your best bet.
help me parents. Labor control. Low help me parents. low. Let me see.
I'm not sure what to do here. I don't feel comfortable streaming from their YouTube page, and I don't feel comfortable streaming from their CNBC page. So I'm not really sure what to do here except keep hitting refresh or to just kill the stream. I don't really know. It's only fitting that this would be the last Fed stream we do, and this happens on reiterating. Yeah, probably a good idea to stop doing these. Tommy Peterson says, do sound only. I can't. If I could, I would, but I can't. So, like everybody, I don't know. It's not my computer doing it. Right. Like if I do it from a different browser, what happens? No, it's completely ruined on that one too.
It's not me, but and we do.
Oh, do the sound from the Fed live stream? Okay, I get what you're saying. All right, let me turn audio off. Make sure no ads play during it. All right, we're going to have Powell pretty much stuck here like this, but we'll hear him in the background. Okay, guys?
About Fed independence and the importance of it over the years. But as markets have questions about what exactly President Trump's intentions are with the Fed,
we don't know what happened
would
here,
you
right? We don't know
point
why the
to
market's
as the
upset.
things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 0.25 percentage point now is going to arrest that?
Well, I hadn't say that I thought a 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut. But the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by inflation was really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues do not think about politics. This does not enter the room. but one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that. But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, there you have it. The most wonky live stream of the Fed we've ever done, which is also our last one. Dude, okay, so I had time to think about what was going on. We had over 8,000 people watching the stream in here. I imagine their website was bombarded, and I'm assuming they just didn't have the upload bandwidth to be able to handle that, to push that thing out. And so my assumption is they just dealt with an enormous amount of bandwidth, and it ended up killing them. I unfortunately, I don't feel comfortable streaming CNBC or directly from YouTube page, things like that. I'm okay with doing it directly from the Fed themselves. But when it comes to any other type of platform, just, because it is what it is, I got to protect my channel. I didn't end up doing that. So we ended up just doing audio, guys. Hard to say. I don't know. I think he still was kind of wishy-washy. Obviously, it felt like we missed meat of the conversation, but in the moment where the stream was going down. But, what did we see? We saw prior to him speaking, we saw the price shoot up and hit the all-time high within a point of it for the Russell. Then as he's speaking, comes all the way down, and then it just kind of settles back to where it began, right? So not a whole lot of change of where prices were pre-meeting. This is exactly where the price was prior to the meeting starting. So we're right back there, right? Big shoot up, big pull back, and then we end right where we are. So we're going to have to give it a couple of days here for the rest of this week to let the market digest it and tell us what are we doing, right? So here is where the day started, right? To give you an idea that the Russell 2000 is still up for the day. We're going to look over here. You could see that the Dow is up 291 points. The Russell is up 16. The S&P is up 5. The NASDAQ is about flat. It's down 0.01%. Gold is down $28. Silver is down almost $1. DXY went and set new lows, but now still hovering back down here. You can see gold. It was all over the place for gold too. So we're going to kind of give this a day or two to let the market kind of digest itself and give some more clear direction on what it thought. It didn't sound like what we were hoping for, right? We're all hoping for a very strong Fed put to say that they're heading in one direction or another. But, he acknowledged the downside risks and that moving away from a restrictive policy is the right move, and that we're now moving towards neutral. Of course, everybody wants to hear we're moving towards accommodative, right? So we all want strong Fed put, but we're just going to have to wait and see. And today, boy, it teased, right? But many times, like we say, the first move is the false move. Then there's a live stream, and then there we are back exactly where we were before the decision ended up coming out. So we'll check in on this tomorrow. We got a little bit of green coming back to the cryptocurrency market, but we'll check in on it tomorrow. Thank you guys for tuning in. Thank you for watching. Thank you for the 5,000 of you who stuck around through an absolute trash show where you didn't have any visuals and you had to just kind of run with it with audio. I love you guys for sticking through it. Thank you. There were a couple of super chats that came through here, and let me address those before. Exceed had said, thank you. I appreciate everything. Learned from you, bro. Man, you are the man. Thank you, brother. Per Jerome Powell by Eric Martinson. Dollar liquidity question. Overrated the stability. 3 layers extra. Oh, guys, I've already gotten these. Chromadio said, good luck, folks. Thank you for streaming this BCB. Thank you. Stacey Rob, 1977. Thank you, sir. Let us all go. Thank you for keeping us sane. BCB says, pin. Adrian, member for 14 months. Thank you, brother. Oscar said, hit the like. Dude, I wonder how many thumbs down this one's going to get. It deserves it. It deserves it. People were telling me to stream from YouTube at this point. AF11, Kashav, Lakshman, who thinks this is rigged. I think it was just they were overheated with traffic is what ended up happening. And that's why, of course, it was still okay on YouTube. Because YouTube is used to streaming tons and tons and tons of traffic at all times, and the Fed is not going to knock YouTube down. I mean, Mr. Beast is going to do more than the Fed is going to do. Arm day for 6 months. Moon trip canceled, boys. Andrew Rawls, man, remember, welcome. Nobody, just a witness for 11 months. 5237 YBCB, that's good. You're the best. Yes, sir, you sure are. Must respect. Thank you, sir. Thank you very much. Brady Perrin, new member, welcome. John FX, thank you very much. It's great work as always. Thank you. Thank you very much, John. All right, guys, there we go. We'll see how the market does. It looks like we're kind of stabilizing here now that we've gotten through the meeting. The Russell 2000 is really just a tick higher than where it was before the rate decision came out. Of course, this is the daily open, so we're up a little bit off of the daily open. We'll pay attention to the rest of today and tomorrow and Friday to see how the market goes. And fingers crossed that we can go back and try to stab at this thing. Otherwise, I don't think we got a whole lot of info out of here on price action or direction happening in here. We're still just going to be sitting up here at the highs with the altcoin market still just sitting up here at the highs. Obviously, that's our stab in the pre-meeting, the pre-presser, and it's still back to where we started at. And we'll see how tomorrow goes and see if we can get some more price direction in here. But Bitcoin looks to have restabled itself back to 116,000 and more green coming back throughout the market. So we'll check on it tomorrow. Night Shift says, go back and listen and skip the sounds like he is saying de-risk. LOL. I'll have to go back and listen. I'm going to find a transcript of it is what I'm going to do. All right. That's it, everybody. Thank you all so much for tuning in. Steve Mant says, thank you for your time. As always, BCB, you keep us sane. Thank you, guys. Thank you for tuning in to all the Fed streams, guys. We've been doing this for over 2 years. It's only appropriate that we had all these issues here on the very last one. I appreciate all of you for tuning in. These were my best performing streams, right? But it's like God said, yes, it's the right call, right? Like that was something that was completely out of my control. It doesn't matter how much prep I do to get the thing ready. There are things that are out of my control when it comes to streaming these things. So I know we've had issues in the past, but never, of course, to that level. So, all right, guys, thank you so much for tuning in. Thank you so much for watching. You can check out the newsletter at blockchainbacker.substack.com. Have yourselves a wonderful day, and I'll check in with you tomorrow. That's it. Thank you so much for watching. If you could, please like the live stream and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you can be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.